Good afternoon and Happy New Year, Mr. Governor. My name is Nduka Chejine of the Nation newspaper. You are very aware of the US and other advanced economies adopting normalization policy of raising rates so as to tighten and mop up forex liquidity. Why is Nigeria monetary policy not following this lead, given that there will be large forex outflows?
To withdraw them from the economy by raising rates. You are very correct. That is true. Normalization will naturally lead to capital flow reversals, particularly for the emerging markets and developing economies, because usually, as a result, some of those funds that were released into the advanced economies during the period of COVID-19, some of them actually flowed into the emerging markets to boost foreign exchange liquidity in the emerging markets. But let me say that whether you call it fortunately or unfortunately, but I'll rather use the word fortunately for Nigeria, when those flows were moving to the emerging markets at a time when the advanced economies were offering stimulus into the economy, those flows did not come into Nigeria. And indeed, since almost or more than about 2 years ago, what we have been doing is to see to a gradual and systematic and orderly exit of foreign portfolio investors out of the country, because they feel that the yields are not as high as they expect, and they also expect that there should be some more hedging instruments that will protect them in case they want to go out. You all recall that in the last 2 years or so, the Monetary Policy Committee had adopted a policy of price and monetary stability that is conducive to growth. And if we're talking about price and monetary stability, monetary policy position that is conducive to growth, it not necessarily means that the CBN or the monetary authorities had to adopt a somewhat policy of accommodation that brings interest rates to a low level, right? That will attract borrowers or people who have projects to embark on projects. And that is the reason you would have seen that we have aggressively, in the last 2 years, seen an increase in loans, whether to households or to small businesses or to large companies, at no more than 9%, and for 10 years. The essence of this is that we believe it will help to boost manufacturing output, it will help to boost agricultural output, and that has been instrumental in us achieving, in reversing the recession, reversing the contract of recession, and then increasing output growth, even while at the same time we're doing everything possible to moderate inflation. So what am I saying in essence? The funds that will be leaving as a result of policy normalization from the advanced economies did not come to Nigeria, and so as they withdraw them, there is nothing to withdraw out of Nigeria because we are not part of that game. So I'd like to assure us that it's not affecting us. However, another stand will say, what has happened as a result of, or what caused the policy normalization in advanced economies is because of rising inflation. And I must say that it is the truth that inflation has attained unprecedented levels in these economies. Is it in America? Is it in Europe? And I'll read some, for instance. The US inflation rate attained 7.08%. This happened to be the highest since 1982, unprecedented. The UK inflation attained 4.2%, which is the highest since 2010. In the EU area, inflation attained 5.5%, and it is the worst since the European Central Bank and the euro was created. So you would imagine that if these are unprecedented levels of inflationary pressure in these economies, they do not have a choice but to really think of how to aggressively rein in inflation because of the liquidity surfeit they see in their environment and the need to rein in prices to a level that is acceptable. Because most of those governments are already facing the threat of even losing their next election as a result of rising prices and inflation. But for us in Nigeria, like I read, our challenge is not just inflation, but also growth. And this is a policy we've been adopting in the last 2 years. And if we feel that this policy is working well, there is no reason for us for MPC to begin to contemplate a policy of tightening, because we see that we are somewhat moderately tightening the liquidity system through our administrative controls using CRR discretionary powers that we have. So I think that's the reason we feel, MPC thinks that we will continue to do what we're doing now, because we believe it is giving us the results that we expect. Let's not forget that as a result of these policies that we've adopted, price stability that conducive to growth, we saw a reversal from recession after 2 quarters. As a result of the policy stance we've adopting, price stability conducive to growth, we saw inflation moderating consecutively for 7 to 8 months until we saw inflation uptick in December 2021. So monetary policy thinks, unquote, that this is temporary. What happened in December is temporary, it is transitory, but there's a need for us to look at it again and monitor it. Because we saw in December 2021, both the core and the food trending upwards. We would have expected that even food should still be trending downwards. But of course, we're looking at it, we think that it will be reversed, because the harvest for 2021 was very, very good. But we have noticed a few challenges that we will address over time. So nothing to worry, because those countries that are raising rates, or even if there are some emerging markets that are following them by raising rates, those economies are indeed facing pressure, because they will, if they are not already, facing capital flow reversals from their economy. So we are not in that game, and that is why we are not following them in that direction. We want to remain where we are right now, hold, watch, because we believe what we're doing is working well.